building value to sell your business. A lot of our clients have been selling in the last year or so, and we've been lucky to be their valuation experts and the transaction advisory people. And by transaction advisory, I don't mean iBanker. I mean that we help them through the transaction process, through the transaction diligence, to assembling their materials, to have them ready for diligence, to make sure that everything is up to grade with what a buyer would expect. And we've interacted with the attorneys who are doing the transaction, and we've helped also with the investment bankers close the deal. Often we've helped select the investment banker and the attorneys who are working on the deal. So that has been a business that we've been doing for about 15, 20 years. It's a part of our firm's work. And overall, I think I've worked on 50 transactions, again, in that capacity as a transaction support and valuation experts. One of the things we do as deal terms change in the contracts or at an earlier stage, we help do a sensitivity analysis on what it means to the seller, what it means to our client. In all of those situations, we work for the sellers. All right, my goal is to help you prep your business for a sale. I want to also give you a sense of when and what expertise is necessary to get there. And then I want to share tips to build and grow value. All right, so let's talk about the basis of what we look at in typically valuing a business. We're going to look at identifying your gross margins of your business, and that is more for people who sell products than service firms. But many companies, many businesses incur a cost of goods sold, and the gross profit is what is left to pay all the other expenses of the business. And so that is an important factor to look at when valuing a business. Revenues, calculating sales, average sales price, the average sales multiplied by the number of items sold. Again, this is a measure for businesses that sell items, but we also have, for example, law firms, investment banks, and other type of service providers where we look at revenue generated by each individual to get to the total, and also to look at a ranking of the top performers and to determine their influence on the bottom line. And we've participated, for example, in the sale of large advertising agencies, large law firms, or other consulting firms, and the ranking of who is generating the most business, whether there's a concentration there, becomes important. For manufacturing, it's important to figure out how many widgets a business sells, how many cars a auto distributorship or dealership sells, how many TVs a TV manufacturer makes per year, and how many, and what's the total sales per item, gives you a sense of the unit revenues. And what is also interesting is that if there are different models of the same product, it's nice to have a breakdown by product of revenues, breakdown by geographical area, and a breakdown by other metrics that are relevant to understanding how a business works. Well, earnings before interest, taxes, depreciation, and amortization, otherwise known as EBITDA. Well, EBITDA is basically the most commonly used multiple or metrics to figure out the value of a business. It's the gross cash flow available before taxes and before interest, depreciation, and amortization. All right, multiples. This is what we obtain by looking at past transactions of similar businesses. Where do we obtain that for privately held companies? From many databases we subscribe to and research into different areas where maybe the transaction was not reported to a database. Sometimes, well, let's start with what the business is. The business is an organization. Organization has systems, has sometimes inventory, has financial records, has employees, has a history, has customers, many databases, many other intellectual property having to do with its product. It is important to organize all that. As you prepare for a sale, a buyer is going to look at everything you have in your business. Its history, its systems and procedures, its inventory, its books, its employees, its intellectual property, its equipment, its machinery, everything that makes up the business. Now, branding, very important, even more so now than ever before. The branding part of your business will probably gain more value. The brands you have gain more value than the operations of your business. What does that mean? Well, your brand multiple, let's say we separate the brand of a business from its operation. You set up a separate company, you move your brand there, and you pay royalties to yourself, let's say an LLC, and that LLC is called My Company's Brands. And the company where you're operating from is called My Operations Inc. All right, that's where you have all your employees, you pay all your salaries, you manufacture, you own all the equipment, etc. Now, the branding is in My Brand's entity. That My Brand's entity only receives royalty income and is shielded from the liabilities of the operating company, the manufacturing company, or the service company. Well, what kind of liabilities does a service company have? Product liability, employee liability, officers and directors liability, accident liability, workers' comp, name it, tax liability, etc. There can be many liabilities that come with an operating entity. Why? Because there are people, machinery, equipment, location, products, deliveries, and all of that create liabilities. So when you separate them into a branding company, you automatically pay every month a percentage of your revenues as a royalty to the branding company. That royalty company's multiples, once it's established and your company is doing well, that multiple for the branding company can be a multiple that is 50% to several 100% more than the operating company's multiple. Why? Because brands collect royalty with no cost and no liabilities associated with it, or very little cost associated with it. Much more valuable, no liabilities, and it's usually a coupon. You collect it every year, every month on a percentage of revenues generated without the liabilities. So let's keep that in mind. Refine your messaging and your brand, whether it's advertising or the name of the company, captures your audience. Pepsi or Coke, McDonald's, Wendy's. It captures the audience. The more refined, the better someone can visualize the brand. That helps you retain customers, retain clients. Sometimes it's different. Customers typically used for retail businesses, clients are used for services and other type of businesses. But it helps you capture your audience and also helps you ultimately create a culture for your company. The image of your company is often associated with your brand, with the name of the company, and also the name of your brand. Work culture. And a part of branding is also your work culture. The goal here, when you prepare your company for sale, you want to leave your business in the hands of people who have worked with you for a long time, loyal, enthusiastic, diligent, and self-sufficient staff. Buyers, when paying for a business, want to make sure that the people that make that business happen are going to be around for a while. Even the owners of the business, the seller, are often asked to stay as CEO for a couple of years, 3 years under an employment contract, sometimes under a bite the apple twice concept. Instead of selling 100%, you sell 80%. You stay on board as the CEO, and after 3 years or 4 years or 5 years, whatever is agreed, you're bought out at a different multiple or at the same multiple, but at a much higher level of revenue or EBITDA, depending how we set the formula for the second buyout of your shares. The first buyout is on the 80%. The second buyout is 3, 4, 5 years later. And that can be a different formula, or it can be the same multiple. Let's say that you sold at a 7 times EBITDA and your company was doing 10 million EBITDA when you sold the first time. 3 years down the line or 4 years down the line, you grew the EBITDA to 15 million. If you use the same multiple, that's your second bite at the apple, and you can make a nice additional payment.